Hello, everyone, and good afternoon, or depending on what part of the country you're in, good almost evening. My name is Kristina Kuprina, and I'm the lead portfolio manager and economist at Sequoia Wealth Advisors. I believe we have some new people that will be either live or also getting the recording later. So I'll do just a couple of introductions. And my apologies to all of you that have heard this before. So we do these webinars approximately once a month or when there's a major economic event going on. And the reason for that is to share information, to give updates, kind of get through all of the noise in the news, and bring up the topics that are most important to you based on the questions that you send in advance. One thing that I just want to make a note that's a little different than our previous webinars is new regulations out, and they have said that you can no longer use the Q&A live on Zoom for reasons only regulators can understand, because I loved that thing. It was great. You guys could put questions live and could answer them live, and I always got surprised by what was next. But unfortunately, we're not able to do it any longer. So our workaround is if you reply back to the email that you got the invitation from, Caitlin's watching this live, and I'll be checking in with her occasionally to see what questions come up. Again, not intending to make it more complicated or difficult. It is a regulatory thing that we have to comply with. Also, as always, you can send your questions in advance. A lot of you do, and I use that and kind of incorporate it into the presentation so the information is as valuable as possible in the time that you're spending. So yes, of course, lots of questions as we're starting to have an outlook towards 2026. And I'll let you know, this is the preliminary outlook. January will be the official one. So just wait for that because there's a lot more in there because we're still waiting for some data. This is a big week. What the Fed says, not what they do, is going to have a really big impact on things. So I'll talk a little bit about that. But there's a lot going on in the world right now, as there has been for some time. And that being said, this is a moving situation or fluid situation. So with that being said, I'm going to jump in and talk a little bit about it. So the overall format, again, peppered in with the questions, is talking a little bit high level about the economy and about the markets and about the topic of the day or what's usually going on that a lot of people have questions about. Again, I want to make this real and relevant to you. So please send in your questions. If your question's unanswered today, or if you have a question later, you're listening to this recording later, you can always send them. I will always get back to you with answers. So if you miss this opportunity, it is not your last one. So without further ado, I'm going to jump into it. So a little bit of just kind of what's going on right now, because the big question continues to be, how can the markets be doing so well with all the things happening in the world? And there's a big high level reason for that is there are a lot of different things that drive the market necessarily than what drives people's day to day. So there can be a lot of similarities, but there also can be a lot of disconnects. So what we're seeing in employment data and what we're seeing in consumer spending, and also what we're seeing in other economic data points is divergent right now. Overall, it is pointing towards growth. I would expect that we will have some volatility though. We're hitting this sort of softer patch late this year and early next year. That could create some volatility, especially because the markets are up so much this year. So if you've seen the charts, right? Market goes up, it pulls back, it goes up again in an up cycle. We're still in a growth cycle, but we do need to have these corrections every so often. They're healthy and they're good, and they're not something to be concerned with as long as the underlying data is supporting the continued growth. And that's something we watch very closely. So that being said, we will likely hit a bit of a soft patch, can see maybe more market volatility later this year, earlier next year, and it's not a hairbringer of things to come. As far out as we can see comfortably, it does not appear to be a recession. Probably not at all next year, but certainly not in the first part of the year at this point. Again, barring a shock to the system or something that can't be seen in data at this point. But we do expect this kind of slower period, and a number of drivers are in that. Again, when you have this big run up, it's not an uncommon thing to have pullback. We also have a lot of rapidly changing policy environment, which I'll talk a little bit about as well. Some we can see, we kind of know, for an example, how the Supreme Court will rule on the tariffs, other policies that are coming up that are either being debated in the courts or we're likely to see how that impacts the economy. And we know they're coming, we just don't know what the results are going to be yet. Other things are policy, it's just completely unknown at this time. What will be the next thing and how will that impact the economy, positively or negatively? One other, I guess I should say a little bit disclaimer I like to say when I'm doing these webinars is two things. Number one, I'm not here to get into the politics or take a political side one direction or the other. I'm talking about data and policy as I see it and how it applies to the economy. But I want to make that clear. I'm not getting into the political aspect. I will answer questions, even if they're political, that come across, but I'm focused really on the economic aspects of things. I do well understand that there's a lot more that goes into what's important and valuable in people's lives than just the economic data. However, my role here is to be the economist. The second thing is that, as I mentioned earlier, data is constantly changing. So what I'm saying today, on December 9th, 2025, could be very different after the Fed speaks this week. So this is a rapidly changing situation as always, and I will be taking the appropriate action in clients' portfolios as well as with clients' financial plans based on how things play out. So this is a moment in time based on data that we have as of today. With that being said, final thing is I don't in any way intend this to show any lack of empathy or understanding of the fact that the economy is not the same to all people. And I'm going to talk a little bit about the K-shaped economy and kind of what's going on. But again, there's obviously economy is a broad numbers. It's data across the nation and even around the world. Everyone's personal economy is different. So in no way am I saying this is good and someone say, well, no, not so good. It depends on your individual situation, what's happening in your life, and where your money needs to be allocated. So again, without further ado, I'm going to hop into it. So a little bit of where we are right now. The big question is what's driving the markets. A big driver of the markets is twofold. The biggest one is we just came out of an earnings season, and earnings overall are good. Companies are doing well. They're navigating the uncertainties fairly well. They're navigating inflation. They're navigating tariffs. It's not 100% across the board, but for the most part, they're navigating this space. We're not really seeing it impact companies' earnings or guidance in a meaningful way across the board. So like any other policy change or any other event that happens, some companies can navigate it more easily than others can just based on their industry and how they're structured. But overall, we're seeing not only positive earnings, but also positive guidance. So that is one driver of the markets. It's the money's there, as we say when we see the earnings reports. The second thing is, and we just got a really important report, which is consumer spending. As everyone probably knows, the holiday shopping season sort of officially opens. Used to be Black Friday was the big day, but it's expanded since then. And now there's tracking what people buy on Thanksgiving. Sitting at home with the family and you got some downtime and you start your shopping online, right? So Thanksgiving spending, Black Friday spending, Small Business Saturday, Cyber Monday, kind of is extending in that sort of the big shopping season. And even that's sort of changing, right? Because it's not so important you buy all your stuff early if you're shopping online. So you don't necessarily see that big clump in 1 or 2 days as we once did see. However, that weekend data, and even before pulling in Cyber Monday, we were 9.1% over last year. So what this shows is the consumer, who's 2/3 of our economy, is still spending, and they're spending more this year than even last year. Yes, you could say, well, yes, of course, inflation, everything costs more. That's true. However, people are still spending, all right, across the board. And again, everyone's situation is different, but that is, if the consumers are 2/3 of our economy, that data that came in on the spending weekend was another driver. So these are two, there's more, but these are the two that are really kind of pushing things at this point. Where a lot of uncertainty lies right now is, again, what the Fed's going to say tomorrow. It's not so much whether they cut or they don't cut. It's sort of a foregone conclusion at this point, largely due to the fact that inflation has moderated significantly. We've been bouncing around in the threes pretty much all year. And so that's not as much of a pressure. They're going to focus much more on employment. Employment data is kind of a mixed bag. There's some areas say, hey, hiring's slowing down, but so are layoffs, right? So everything's kind of sitting fairly stable. And the employment data, if we stay in the 4%-ish, plus or minus in the unemployment data, that's usually a positive sign. And right now, the data shifts, but it depends, of course, depends what you focus on, but collectively, and a lot of that may be that companies are sort of in a holding pattern, right? The economy's doing fairly well. There's concerns, but it's doing fairly well. So we don't want to lay people off because what if we grow at the same time? We don't want to hire too many people because we don't quite know what's happening next. So this sort of, waiting period, which would, really fit in with this kind of slower down in the economy. We've had amazing GDP growth this year. I think the second quarter was one of the highest quarters in years, many years now, at 3.8. What we just had this really, really solid growth, and it was organic growth. So that was a driver. We will see a softening in that data, and especially in the last quarter of this year, probably early next year, as we hit the soft patch. But at this point, it doesn't appear it will be negative based on, again, current data and what's happening. So again, these are kind of the drivers right now. You likely see more volatility at the end of the year anyway, because there's a lot of portfolio rebalancing, which is pretty much what I spent yesterday doing, but all of us are doing the same thing, kind of repositioning. So there's a lot of things, just money movement within the markets, year end and whatnot, in addition to anything that happens with data. But what the Fed says is more important than that rate cut. So the biggest risk is what they do. The Fed does what's called a hawkish cut. A hawkish cut is, we're cutting, but this is the last one. That is not going to make the markets happy and whatnot. And that is going to kind of set apart a little bit more concern if, of course, that's the path they go. So the other one is, of course, if they get too dovish and say, hey, we're doing lots of cuts, and it's like, oh, wait, do you know something we don't know? So either extremes, even, regards to cuts, is that guidance that they give us that's going to be really important. So if anything, any word, any facial tick, anything comes up with the Fed tomorrow that will drive that, then you could see volatility simply tied to that. And that has nothing to be concerned with. It's more just that market reaction, because the market's just looking for a reason to correct right now. It really, really wants to. And that may be the driver, but it wouldn't be an economic impact over time. It's more so short term. The other thing too is the Supreme Court any day, sometime before the end of the year, we believe is going to rule on tariffs. Depending on what the Supreme Court's ruling is, that could have an impact, because that creates more uncertainty. If they rule against the tariffs, that will create economic uncertainty, and it will create a lot of questions. So the market will likely react to that. However, it does depend on the details of what the Supreme Court says, because almost certainly the administration is going to come back with another way to do things. So it depends on how hard that language is, or how much opening there is if, again, they rule against tariffs. So those are two things in the short term that could be drivers, of course, for the markets and for the economy. I just wanted to bring, because I want to tie in your questions to it as well. So big questions that are coming up a lot is, with all these tariffs, why, again, is the economy doing well? Why are we seeing a bigger impact? Yeah, the tariffs were big. Some sectors saw it go up 10 times from what it was previously, right? In certain industries and sectors. They're big. Companies were able to offset a lot of this from a few different moves, depending on the company. Some front-loaded. They knew they were coming. It wasn't a surprise. So they front-loaded, did a lot of pre-buying, kind of locked in before tariffs. Other companies were able to offset lower costs elsewhere in their business to hold back, so the margins got pushed a little bit, but they were able to hold back the cost increases to the consumer, to the next user of their products, and technological advances as well. We're starting to see that more and more companies invest in technology to create more productivity. They can offset some of those costs, and so they're able to hold their prices a little more stable. Again, I'm being really general here. We all know the stories about something that went way up. There is a little bit of excuse making sometimes. When we first had the big spike in inflation back in 2022, when we shot up 9% or over 9%, there was a whole lot of people saying, oh, it's inflation, that's why we're raising our price. Like, you aren't even impacted by inflation. It was just an excuse, right? So sometimes you do have tariffs sort of being excuse making for price increases that companies desire to do anyway, or need to do anyway. So that is at this point. Now that can change. That can change over time, because, as you probably well know, tariffs keep changing. So there could be a time when a tariff gets taken away or reduced, and it could be a time when it's increased. This is going to be definitely a big part of policy, I can see, at least through the rest of this administration. And so that's going to be an ongoing thing. But it's not a lot different than any other administration's policies, right? There's winners and there's losers. The challenges especially with certain sectors that are importing, is that there's a long lead time. So it's hard for companies to plan their costing if they don't know what those tariffs might look like if they're importing from overseas. So I won't go too far in the weeds on the tariff stuff unless more questions come up. But that was just on a high level of why we're just not seeing a big impact at this point when we start breaking down inflation data as well as company cost input data. So that's the way that many of them are addressing this right now. The inflation is another question that came up a lot. So I'll talk a little about inflation. I mentioned inflation is, I have a chart here. I should just screen share it. Maybe I will later if there's time. So inflation is bouncing around its head in the threes, which is actually historically normal. The Fed would love to see it down at two. But if we look back and not taking the big spike we had in 22 and not taking the really high inflation we had in the late 70s and 80s, that's, in the fours is not that unreasonable and not that, sorry, threes and fours is not that unreasonable, not that unsustainable, provided wages are rising in tandem with that or better, which is what we're experiencing now. Wage increases have been going up faster than inflation. Caveat, national numbers, your individual situation or individual people's situation could be very different. And I want to kind of talk a little bit more about inflation because inflation, this national number of 3%, people say that can't be real, that's got to be fake. My inflation is a lot higher than 3% because inflation is more than a national number. Inflation is your cost of living or your company's expenses, right? So let's just pick on, because that's where most of you are, in California. Okay, so in California, it's an expensive state to live in. Oh, nobody needs to tell you that, right? The cost of housing, the cost of just about everything is an expensive state to live in. But what's really hit a lot of people, especially people on a fixed income or in the lower socioeconomic levels, has been the fact that the PG&E bill for the Northern Cal and the Con Ed for your Southern Cal has doubled in the last 4 years. Doubled. And that's a necessary expense. That's not an expense, it's optional, right? The cost of homeowners insurance, not just California, but other states like Florida, has skyrocketed. So your personal inflation has skyrocketed. And if we look back when we had almost no inflation during the 2000, after the financial crisis, right? We had incredibly low inflation for a long time. People who are sending their kids to college would have argued that we had almost no inflation, right? Because college costs were skyrocketing, healthcare costs were skyrocketing. There was inflation, it just wasn't seen in the national numbers. So your personal story can be very different depending on what your expenses are, where you live, and other factors that could make things more or less expensive for you personally. And that's why this number is very localized as well as a national number. The other thing I'll touch upon inflation, which will bring a little bit back to the economy, is you may have heard this. This is a term we've used for years, but I've seen it now in the news media. So now this may be more familiar to you, is a K-shaped economy. There's different names for it, but K-shaped is good because it's nice and visual. So imagine the letter K, you got one part of the K going upward and little part going downward. And we've had about 3 K-shaped economies since the financial crisis. And what that means is if you take the socioeconomic scale, okay, and you divide it by 3, upper class, middle class, lower class. The upper class and middle class, because they're experiencing rising wages if they're working, or rising asset prices, housing, stocks, investments and whatnot, they are in a different position than people in the lower side of the scale that may not be working, so not experiencing wage increases and don't have necessarily the assets that are appreciating. So what that means is people, when you're able to, the wealth effect is, as it's called, right? Able to absorb that higher cost of living and even thrive in it, are spending, and they're literally driving our economy right now. So middle class and upper class is driving our economy, driving spending and driving what's happening. People on the lower end of the scale are getting crushed by inflation and cost of living. Again, I mentioned, electricity bills and things like that are getting crushed by cost of living, but don't have the safety valve necessarily of rising wages or asset appreciation. So that's why it's a tale of different economies. And that's why you can hear people saying the economy's in recession. The economy is terrible. Everything is bad. And other people saying, we're fine. What inflation? And it's really more that dividing line of the wealth effect is there. They're benefiting from the growth or they're not. And in the last 2 times this has happened, eventually the lower side of the K started to pick up. It was through policy changes, it was through adjustments in cost of living and whatnot, but they picked up and then it rose the economy a lot more, I should say, equitably, right? You start to see more of that rise. We'll see how that will play out this time. It's unknown at this point, but that is something to watch for. And if it does pick up, it'll likely start to pick up in the spring, right around the tax season. So that's what we're watching for right now with the K-shaped economy. And that also may explain why there's so many different views of how the economy is doing based on people's individual situations. And sometimes I say based on how much news you consume, because that's rarely positive out there in the media world. So that really gets into all that affordability. As I said, it's not just the official inflation numbers, it's what it costs you. Some states, some regions cost more than others to live in. And again, some things are necessities you must pay for, and other things are not. A level of uncertainty too sometimes has people be much more cautious. If you feel like your job is stable or your sources of income are stable, you may spend and do things differently and absorb these higher costs for discretionary purchases. If you don't feel stability, you're just going to rein it in and say, hey, I'm going to go to the food bank. I'm going to, cut back on my spending. I'm going to do this and that because I don't know how this is going to play out and I don't feel comfortable or safe right now. So you're seeing that demand kind of really pick up for a lot of these services just because of that level of uncertainty. So driving to the affordability slash inflation issue and to the tariff issue, a kind of a high level. The one thing I want to say is that we are starting to see areas of slowness, and we're also starting to see areas that are just starting to grow. So that's going to be a really good tie into the whole investing and market landscape. The question that I've gotten a lot has been, are we in a bubble? Which happens pretty much every time the markets go up a lot, right? There's that fear, that concern. It's like, oh, they've gone up so much, they have to crash, right? It's the idea that that's next. Media fuels that as well. So there's a reason that the economy will crash. This time around, its big one has been the AI bubble. And I want to just address that one for a few minutes because by the technical definition of bubble, it's not there. There are areas of the market, there are company areas of market that bear watching at this point. But one thing to kind of define what a lot of people think about a bubble is they think of this like way overvalued and then a crash back to reality, right? And then think the dot-com, right, being the most recent bubble that we had, where you had a whole lot of companies that were making no money, but their stock was trading for $1,000 a share, right? Remember those days? And the idea of it was it's the new economy. Earnings don't matter. It's how many eyeballs, how many people are going onto the internet. But that's not sustainable. In early stages, it can be because it takes time for the technology to catch the income to catch up with the technological advancement or the revenues to catch up with the technological advancement. However, it is not necessary because I'll give another example of another area where people thought there was a bubble in recent years, cloud computing. Massive, massive investment that went into cloud computing. And, these valuations started to get a little stretched and it was like, oh, it's a bubble. But it wasn't because they were earning money. They were earning money and the demand was there. It's earning money. And so sometimes the valuation can get ahead of the money. You just watch, is it catching up? Is it catching up? So you can see a company's stock price getting high and revenues are catching up with it. And you can see sometimes a little pullback for them to connect. And other times you can see the revenues pick up quickly enough to justify the stock price. So you watch that to see anytime you have something that's a significant technological or societal innovation, is that time for the companies to invest and also make money. And with AI, as we're getting these earning report with the big companies, right, that are diversified and have the resources to make these investments, is we're not getting concerns off earnings at this point. We're not getting concerns, but it would be very natural for there to be a point where this kind of pulls back. And as soon as it pulls back, you say, see, I told you it was a bubble. No, just a natural part. We had this with cloud computing. We've had this a lot of other technological innovations in society going all the way back to the railroads. That we just have that state. So that could be the case. And I'll talk a minute about how to minimize that risk. I just talking about the AI bubble. Then the other concern around AI bubble is the term circular financing, or the idea that NVIDIA invests in OpenAI, and then OpenAI buys a bunch of their chips, and they're all kind of intertwined in the circular financing, a sort of dependency on each other. A lot of this is there's very few companies that can meet this massively growing demand. And the adoption rate is stunning when you look at this, actually stunning. So what happens, there's very few. So there's almost like this mutual dependency. Hey, if we want this to keep growing, we got to work on this together. And there is some debt being used to fund some of the data center work and some of these types of circular financing. So that is something we're watching closely. Debt is not a problem. Any of you have a mortgage know that, right? As long as you pay for the mortgage, you pay your mortgage, it's fine. It's a way for you to get into a house before you have the financial resources to fully afford it. And the same goes with corporate debt or any other kinds of debt. So if the companies are not issuing debt that puts a company at risk and the company can withstand slowdowns, downturns, or anything like that, it's not an issue. But we are watching because this is also a race. There's a lot of people trying to get into this as fast as possible because it's moving so quickly. You get a little behind, you're in trouble fast. There's not a lot of room to catch up. It's moving so quickly. In addition, with AI is also a national security issue. So just wait, it gets better, right? We're in a arms race, technological arms race, for lack of a better term, with the rest of the world, especially China. And whoever wins this race is going to win the world. There's no question about it. So it's not as, scary when you think about like a nuclear arms race, right, or the Cold War period, but it can be because there's a massive amounts of money going towards also a lot of innovation. And some of these things, they're not here yet, but they're coming, like quantum chips and whatnot, can really, really be game changers. Huge. So there's a little bit of this national security element to this to kind of pressure us to grow and to innovate and develop this technology as quickly as possible. There's a lot of pushback to that. Two areas of pushback that you hear a lot is the risk of loss of jobs. We're already seeing that in a small way, but it could accelerate in the future. It may accelerate in a way that it's easily adaptable, right? You think about the dot-com era and when all these bookstores disappeared and Amazon became the rule of that. There was warehouses, record stores, things like that. There was a huge disruption in retail as a result of the recovery from that period, right? When more things went online. But people did find other jobs and people adapted to this change. The technological change here is going to be some jobs will just not be needed at the same level that they were needed previously, like analysts and things like that, with the advent of more of this generative AI and a lot of these technologies that are there. So what jobs will people have, and will it get to the point where there'll be a big societal shift? And I could get into a whole conversation about that, but I won't take your economic time with it, about some ways that society will maybe need to adapt on the way that we do things, because working people put money in the system, so there's a social safety net and there's a retirement plan, say Social Security, Medicare, and the rest of it. So a world where we have less workers means there's going to be a world where we're going to have to find other ways to fund a lot of these programs that we depend on. So there is, if this becomes something bigger, there's going to require some shifts in governmental policy in the way that we do things. But there is also a likely path that this adaptation rate is fast enough that people just simply find different professions that are impacted. There's not this idea that everything is going to be done by AI. However, there could be less people needed to do tasks. AI is more of an assist than it is a replacement at this stage. Again, I'm being very general. So different industries and different jobs are at different levels of risk. So please take that with a grain of salt. If you really want to get into it, I have a great report to share, which is, kind of each job type and then that potential risk based on where our technology is today and where it's projected to go. I actually shared it with one of my clients. Kids are deciding what they want to major in college. I said, can I have that report to send them? Don't get these kind of jobs, get these. Or degrees, right? But that being said, the other concern is, of course, data center and the voracious use of resources, energy, water, etc., for cooling. That is an issue, and there's a little bit of fake news that's floating around about that, and a lot of concerns. People said, oh my God, the data centers are coming, it's going to drive up our cost of electricity. And that has not been the case yet based on data on the ground. So the state of Virginia has more data centers than anywhere else in the world. My theory is just the proximity to Washington, D.C., but I don't know exactly why. But Virginia, more data centers than anywhere in the world. Their power costs have not gone up meaningfully in 10 years. And we'll combine that with, say, California. Sorry, I got to pick on California again. So if you take the nation's power cost and you take 49 states, take out California, take 49 states, take the median price, and you take California's energy price, north and south, Con Ed and PG&E, 77% higher than the rest of the nation pays for energy. So some of this is state level policies and things like that that can drive the cost of energy. There's a lot of variables in there, how much investment's being made towards green energy, non-fossil fuels, what's the cost of things, and who pays for it, right? So energy costs are not linear across the nation, but data centers in their own right do not drive up the cost of power to date, right? We can't see anything to substantiate that. However, they do need a lot of power. That doesn't change, a lot of power. So what some of these companies are trying to do is literally build their own power plants. Within the bounds of regulations, obviously there's oversight and everything like that. They have to be regulated no differently than the local power sources, but they're working in a lot of investments in our client portfolios right now. Sometimes people say, why do we have that? Because they do this. And they're big companies. They do a lot of other stuff. So they're not just a little startup. But they're actually working on building their own power plants because this, number one, takes it off of the infrastructure of everyone else, so it takes that fear and concern away. Number two, they're also needing to generate their own power for these data centers. The data center controversy about that is not going to go away anytime soon. It's going to be an ongoing thing. The other challenge is that people want municipalities want the jobs, they want the resources, the taxes, everything that comes in with that, but they also have to balance out making sure that their citizenry feels comfortable and safe with the power and things. So this is going to be an ongoing debate, and we've seen some states reject data centers. Recently, Arizona, and I don't recall the other one off the top of my head, that didn't want more built in a certain community just because of these concerns. So that's going to be something that's going to keep coming up. And solutions, because this is moving so quickly, are going to be a combination of fast moving technology, which is go, 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 and much slower moving government and regulators. So this will be an ongoing thing. And that's another thing that can drive some of the fits and starts in AI and technology, is just going to be regulations kind of chasing after it and maybe over-regulating something and stopping growth, or under-regulating something and having unintended consequences. So that will be something that will play out over time, because we can all agree the government does not move as quickly as technological advancement. So bringing that, I'm going to take a quick break and see if there's any messages in. Okay, here we go. I'm going to take a break. I have more things to cover, but I'll take a break here at the halfway point and say, I wonder if there's any early indicators to what November looks like for many B2B businesses. We and several competitors are cruising along fine through the end of October, and November slowed way down in general economic conditions, or a knockout effect of the, okay, hey, you said it, I can say it out loud, twits in Washington. Shutting down the government down, or another factor that you have visibility into. I actually know who you are and I know your sector. So I'm going to tell you it's a combination of factors. Overall, as you get to year end, you tend to have, when you have a more, uncertain environment, companies kind of like, their focus on other things is kind of closing out year end, and whatnot. So you can just see generally a slowdown of people not making any new spending. There is a level of uncertainty right now, which is causing companies to say, well, we don't want to cut back because we want to be ready for the next run up, but we also don't want to go big because we feel there's uncertainty. And that's happening with a lot of companies right now. The government shutdown certainly disrupted things, because if you had any connection or funding to that, or if you needed governmental approval for something, any of these disruptions with government shutdowns can have this effect where it takes time for everything to get back online. So if your customers are in any way connected to the government, for not only for funding but also for approvals, that can definitely slow things down as well. It's not an industry-wide thing, and we're not seeing this across the sectors, but we did see a slowdown in late year, just to get a slowdown, not a plummet, but a slowdown, and a lot of things are happening. The driver, though, is that tax policy is more certain than it has been for a while, both on the company level as well as the individual level. So that would be a reason for seeing growth kind of reaccelerate into next year. Maybe not in the earliest part of the year, but as we get into the spring. So I think that's going to be a big part of it. But overall, businesses that kind of watch and wait, watch and wait, watch and wait, and year end focuses elsewhere, and we'll wait to see. I don't know any details. I haven't had any chance to follow it. It's busy year end stuff, but the current administration is definitely realized that the American people are really focused on this affordability thing. It's a big deal, and it's going to be a big topic of the midterms next year. So there, I would expect that there's going to be additional policy, additional laws or rules that come out either through Congress or through executive order to help, bring up that lower leg of the K, which will bring up potentially more confidence in the economy overall as we're seeing some of these issues, mitigate. That's my expectation. Again, I'm not trying to predict politicians by any means, but it is a midterm election. Midterm elections historically are the party out of power gains more power. And so this is going to be a big, I want to say fight, but a big political season. The big draw to that, and this someone answers your question, but maybe kind of expands beyond it, is going to be overall the markets don't really care whether we have, how Congress shifts or what happens and whatnot. It really doesn't matter. It's we could see more volatility around policy proposals of the current administration than necessarily how the midterms are going, unless we have a significant hard leftward lurch, Regardless of your politics, that's obviously something that's not going to be favored by the markets for a lot of the economy overall. So that is something that only if we just see this really big move, but we won't even know that till the end of next year. So for the most part, it's just going to be a lot more noise in the media. I think so the midterm uncertainty is probably not going to do as much with affecting company spending. Going to be a whole lot more about, tax policies and things like that, which are more certain. So I would say keep an eye on things and see what you see on your orders, what you see on activity, not only with yourself, with your competitors, with sectors around you, and kind of watch and see what are people doing as we get into 2026. We'll probably give more guidance there. But there's nothing I see in the economy that's like a big, wow, that's why it's happening at this time. Okay, let me just see. The other questions are, if there's more. Okay, so let's see. What are the factors that will bring down inflation and cost of living? That's a really hard one. The reason is inflation is really sticky once it gets a hold. And you've heard me say this before, and I think this is pretty known information at this point. The driver of this inflation was the extraordinary amount of spending from the government money pushed into the system during the pandemic. Early on, we didn't know what we were dealing with. We're shutting everything down. We had no choice as a nation, right? Or we would have collapsed in a way you probably couldn't even imagine. Later, as things were opening up and we had vaccines and things like that, the continued stimulus put too much money in the economy. And the basic definition is too much money chasing too few goods. And so when we opened up again and things became more available and people go out and travel and do things, all of a sudden all that money just started getting spent, and that drives up inflation. It's a money issue. It is really, really hard to suck the money out of the economy. It's actually not that hard to do, but it's not politically expedient at all. So there's no way on earth that Biden or Trump or anyone else is going to want to do it, because the solution is to slow the economy even to a recession. For some of you a little older than me, because I was in high school at the time, but when Volcker came in the Fed in the early 80s, Reagan was president, Volcker came in, the Fed chair, and we had massive out of control inflation, far worse than even the big spike we had in 22. Far worse inflation, had been around for a long time. And the way it was killed was driving the economy into two back-to-back recessions in the early 80s, two back-to-back recessions, and raising rates to crazy amounts. Any of you that had a mortgage back then remembers what those rates were. And if you have CDs, you also probably remembered. But that being said, the solutions to cooling inflation quickly, rising rates can slow the economy. It's much more calmer than driving the economy to recession. But that's the balance as the Fed has been trying to do, is raise rates enough to cool the economy, but not so much that we drive it into a recession. Now looking at, can we lower rates to stimulate the economy and growth and bring down the cost of borrowing and whatnot, but at the same time not do it too much, and then we reinvigorate inflation. So it's a balancing act that has to be done based on data at the ground. And regardless of, every president that's ever been in office wants the Fed to cut rates. Every president. They're not usually as loud as this one, but they all want it because it's stimulative to the economy. But the side effect is higher inflation. And we had very low rates during the pandemic, and that didn't help things either when things reopened. That's why the Fed had to work so aggressively in 2022. That's why we had a technical recession, 2 negative quarters of GDP, and the stock market took a big hit. It was literally just trying to cool things off really quickly. So there is not a lot of solutions just with big high-level Fed policy or governmental policy. That's why I always say it's kind of hard, because you're a new president, you're supposed to fix this, but there's not a lot that can be done. It's only time. It's like medicine, right? It's time. There are some policy things that can be done. Even that takes time. Everything takes time, and we tend to be news cycle oriented. News cycle, right now, right now. How long's the guy been in office? It's not all fixed yet. All this stuff takes time. And so it's not an easy solution, and the solutions that are easier ones you probably don't want to experience. So time and patience. But do keep in mind is, even though it's getting a lot of media coverage, inflation is 3%. And that is not a onerous number. And again, nothing like it was in 22. Let's see here. Next question. Can you explain Trump accounts for kids? How do you set this up? Can I do it for my grandkids? I was kind of saving that one for next year, because they become live early next year. But for those of you who don't know, those accounts were set up during in the OBB Act, the One Big Beautiful Bill Act. No, I didn't name it, nor did I name the accounts, so don't throw any tomatoes at me. That being said, essentially they're savings accounts for kids that grow tax-free. They can be a great vehicle for many people who have children and grandkids. Is another way to save. It's not limited to just college, like a 529 plan. For kids born, I think from 2025 through 2028, the government will kick in the first $1,000, kind of get it started. And family, anyone could contribute up to $5,000 a year. And employers, I believe, can put up to $2,500 a year. So this may actually even be part of benefit packages that employers offer, is adding money to these accounts. I'm not a fan of anything being named after politicians. I don't like Obamacare being called Obamacare. I don't like Trump accounts being called Trump accounts because everything's so partisan right now. So just get past all the naming and then just go straight into the fact that this could be a really useful savings tools for a lot of families. And I will give more information. Right now, we're getting preliminary information, like from the IRS and the Treasury, how they're going to work, but they're not finalized yet. So I'll be able to give you more information. But on a high level next year, yes, you'll be able to put money aside for the grandkids in these accounts. And they could be a really great tool for savings. Okay, next question. I think I answered this one. Market valuations at .com levels, bubble, question mark. Kind of mentioned earlier, but I'll say this slightly different way. Valuations can be high. The question is, are revenues catching up? And sometimes you'll have a pullback to revenues catching up, and other times revenues will catch up more quickly. And I'll give you a really good example about that. When the whole AI bubble stories hit the media and NVIDIA was going to release their earnings, it was like, oh my God, it's going to be terrible, because there was the valuation so high by traditional metrics of NVIDIA stock. And they came out, and not only were they hit all the numbers, but they also guided higher. So that was a situation where stock's really high, the valuations are crazy, but they're hitting it, right? Now, if AI investment slows down, and that slows down, then you can see a dip in the stock price. And a lot of these companies, to have a pullback would actually be healthy and not necessarily a hair-bringer of things to come. But we do watch that very closely because high valuations, especially in growth companies, is not unusual, as long as the data every quarter is substantiating that, or they're getting it and moving in the right direction. But to see pullbacks in some of these companies that have run up a lot would be really reasonable and healthy. All right, last one, I'll jump into this again. What happened with our debt levels? What will happen if no deal on healthcare? I think that's one question. So debt levels, yeah, obviously we all know the government has a massive level of debt, I think 36 trillion or so. There's been numerous attempts and ways to try to get that under control. And each administration learns the same lesson in different ways. The people don't want the cuts. Everybody talks about cuts, but as long as they don't have to pay for them, right? Whether it's lower taxes or more government benefits, people generally want things that benefit them. And so when the government comes out and wants to make any cuts or changes or to reduce the spending, there's a lot of pushback to it. Each administration, again, learns this in their own way. And if, again, there's too much spending, the debt levels go up. Right now, this is sustainable because our treasury auctions are going very well. And there's enough demand, even though we have less foreign buyers for a lot of reasons. We have enough demand that continues to support our debt levels. And truly, the US has more assets, far more assets than they have liabilities in the US. So not that we ever want to sell off our land or do anything like that, but it's not something where we are at high risk at this point. But I have mentioned this before, I'll mention this again, in the coming years, and probably the next decade, this is going to become a very big problem that's going to have a very big impact on our economy. It's a math problem. It is a math problem. I'll watch closely. Our bond markets will tell us when it's time, but y'all may see us getting real conservative real quick when that day comes. When and how it comes is unknown right now because it's going to be completely by policy, not only this administration, but the one that follows them. So as we get into the next decade. But that being said, I don't see any meaningful difference. There was the attempt with Doge and cutting and things like that. But even with that, it wasn't enough to really move the needle. And I don't expect or anticipate anything meaningful to change there in the near future until we have a politician that will tell people the truth about it all and want to take those steps. So we'll keep an eye on, like I said, what it means to you as individuals is don't worry about it now, but also don't ignore it because it is going to come up, and I'll be keeping a close eye on that. Let's see. The top concerns for 26. I'm going to go into this in more detail in January, but let me just touch upon a little bit about this. Big one's the Fed. Okay, not only the current Fed, Powell, right, and policies around balancing out the very careful balance of where rates should be, not getting us into recession, but also not driving up inflation. But there's a lot of other policies the Fed does, a lot of other policies. To support the economy during the early stage of the pandemic, they did extraordinary measures to stabilize the markets. And that happened before Congress ever came out with their first stimulus round. I mean, the Fed has an amazing amount of power to balance the economy, but they don't use it lightly. They're really using it more in, hey, we have to do this. It's a crisis situation, or hey, we can back off now because things are more stable. So it's very, very, very important that we have a Fed chair that the markets and the world believes is doing a really good job. So Powell's term is up next spring, and there will be a new Fed chair. This is not an unusual thing. Each administration has their own people, and we have a new Fed chair. So there's some names being floated around right now, and I will tell you, we're all watching very closely on two important things. Number one, is the person qualified? The ones we're hearing about so far are yes, they're qualified. They're definitely qualified. Second one is, will they maintain the independence of the Fed? Critical, especially when you have a president that's vocally saying, do this, do that, right? And, Powell's done a good job at balancing out that and staying independent, but it's critically important for our economy, for all of us. I don't even care if you have stocks. For our economy to function, it's critically important that we have Fed independence. And that is something that's going to be a careful, careful watch as the new Fed chair is appointed and their actions once they're in that position. So that's something really close watching. Debt levels, I mentioned, kind of what policies we're going to be looking at least to try to stabilize over time. Trump has stated that his idea of tariffs is that's what he's going to do. He's going to use it to stimulate the economy, and that revenue that comes back that will help pay down the debt. It actually theoretically could work. So I don't want to say it won't work at all. It won't work. It could work, but there's a lot of variables in there won't be known, and it probably won't be known until near the end of his term, like next couple of years for sure, if this works. But the idea of it is that we're bringing in this revenue, we're using it to grow our economy, and from we're growing our economy, we're bringing in more revenue, and we use that to pay down debt. Again, this could work. We have to watch, and whether it's successful or not successful, it's obviously it's political opinion, but it's also unknown, completely unknown at this point. But that could help with some of the potentiality of minimizing the future crisis of our debt levels. Valuations, I mentioned that before. I'm trying to bring that up in that thing. And the other one is that K-shaped economy coming back to it. The people at the lower end of the socioeconomic scale, not only are they being pressured, but we're also seeing an increase in auto loan delinquencies. We're seeing an increase in credit card debt. And it was a combination of factors. Number one, a lot of stimulus checks, a lot of money went in, a lot of supports and subsidies and whatnot that was put in during the pandemic caused an increase in debt levels in that socioeconomic group. Just natural, more money coming in. Oh, I'll buy a nicer car, I'll buy a jet ski, I'll buy a motorcycle, right? There was more spending on debt, and as that's money is going away, in addition to the high cost of living, that's putting more pressure, and you're starting to see these delinquencies rise and credit card debt levels rise. At this point, again, it seems to be somewhat contained, but we'll watch for a spread in that. And if that starts to kind of trickle further on, that's going to show that this pressure is spreading, and that is going to be a warning sign. So I'll tell you, I'm watching that one really closely. Let's see here. I'm trying to make sure I'm covering everybody's questions. Oh, no, the question about the farmers. Do I have time? Yeah, okay. A lot of questions today, I think, because there was an announcement on farm subsidies today and about the pressure of tariffs and policy on our farmers. And I'm trying to remember if I told the soybean story last time, so I'm going to be quick about it just in case. There's two different kinds of farmers. I mean, there's a lot more than two different kinds of farmers, sorry, but let's be, for economic purposes here, two different kinds. Farmers that farm commodities that are traded globally, just like oil, right? There's a price and it's global, right? Whether you get that from China, you get it from Europe, or you get it from South America, it's the same price for that commodity, right? Think of oil, gold, things like that. And then farmers that farm other stuff. Okay, other stuff are things that do not trade on exchanges, are not commodities, and are much more volatile and much more driven by policy, by weather, and things like that. Oh, sorry, localized weather. So that being said, farmers who farm commodities like soybeans, If China doesn't buy for us, it's really not a big deal because the whole world is buying a certain amount of soybeans, and they're going to buy soybeans from anywhere that they're going to get the best shipping. It's going to be more about shipping and things like that than the price, because the soybean price again is set. So if China says, originally China said, we're not buying your soybeans, it's like, oh, the soybean farmers, what are they going to do? But then China went to South America to buy their soybeans. And then Europeans who buy an amazing amount of soybeans, Europe, I was amazed. They all of a sudden, China was buying from South America and it's closer for them, right, to import from there. So then Europe's like, where are we going to get our soybeans? Oh, US. So it's kind of like this global economy, like oil and anything else like that. Less disruption. The challenge for the farmers with these types of things is the same for all farmers, which is input costs to farm. So let me talk about the other side too. The farmers that farm non-commodity things. Okay, let's just make up lettuce for an example, right? And Salinas area, Wattsville grows a ton of lettuce. And so they grow lettuce there, and the cost of lettuce it's so concentrated in the parts of the world where lettuce grows well that a weather event can affect the price. Cost, right? Lettuce doesn't last as long as a soybean, right? So there's a shipping factor, right? That if you don't get it out right away, it rots. It's a perishable good. So those farmers have different challenges in this environment in addition to tariffs, right? All of our farmers have input cost issues. So in this world of all these prices, what's happening to farmers right now is fuel prices are dropping. That's getting cheaper, 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 cheaper. But fertilizer's up. So when you're a farmer, you're having to decide how much stuff to plant in the winter, right? How many acres? What am I going to plant? What am I going to do? Who are my buyers? Like, you're figuring this stuff out in the winter before the first seed goes in the ground, before the soil's even prepped. And so if all of a sudden a policy changes when your plants are growing, you're kind of stuck. If you're doing a commodity, you can hedge your crop in the commodities markets, which most farmers do, right? They buy futures, they hedge. If the price declines, the futures will make money. It offsets a loss in their crop. If you're farming strawberries, can't do that. So you have the same input costs, the same risk, but you now have a perishable good and a rapidly changing global market if you're exporting, right? With tariffs and policy and things like that. So the farmers, the big impact is not the soybean. It is all the other issues that are happening there. And that's where the challenge is coming. And quite frankly, there's always challenges with farmers, just given they have so many risk inputs that go into what they do. Bad weather, that's it, right? Bad crops for some reason, an outbreak of something, and all of a sudden people don't want your stuff. It was horrifying for me, who hates to waste food, to see all that food waste that happened when the pandemic hit, right? They shut everything down. And that time of year, most of the stuff that was growing, that was ready for harvest, was in Florida and southern states. And they were just plowing these crops under because all the restaurants are closed, right? Nobody needs your tomatoes anymore. Perishable. They can't sit on a shelf and wait this out. So it's always going to be a challenge for farmers. There's the need for subsidies, whether it's policy driven or weather driven or anything else, is going to continue to happen, because what we're trying to do in this country is to keep our agriculture here and not have too much dependency overseas, for the simple fact of the importance of feeding people. So I want to bring that up because a lot of the news is tariff driven, but there's a lot of other factors that goes into it, and some is tariff. What's happening with the fertilizer is definitely tariff driven, right? And cost. However, other times it can also be that we have a disagreement with a country we're getting most of our fertilizer from, and the same issue comes up, and then another need for subsidies. So hope I got your soybean question answered. Okay, any other questions? I got a couple minutes here. I will get this one. This one again, real estate. A couple questions about real estate. Say, as everyone knows, real estate's very, very localized. So what I'm saying here every market's different. I've had a number of clients that have been buying and selling homes recently, and their stories have been very different. Some people said, hey, it's sitting on the market a while. Other people are like, oh, I sold it in a day. So I think the market really, really matters. A lot of other factors matter. That's why you want to have a good agent that knows your market and is guiding you in addition to the economic. But you have to think about, historically, real estate kind of cruises along with wages and inflation. So what happens, we had this huge spike in real estate around the pandemic, really low borrowing costs, combined with a lot of people moving around and spending a lot more time in their homes. So if you're going to move, this is the time to do it. And so you're seeing this kind of softening nationally in real estate, and wages are catching up. So lower mortgage rates over time, wages catching up. We still don't have enough supply for demand. So collectively, but it would be unlikely you'll see these kind of growths that we've had in recent years in real estate for some time. But it doesn't mean that you're going to have a crash. Slow growth does not equal crash. So generally, what you do with real estate depends on your individual and personal situation. That is key. There's not a right or wrong or good or bad. If you're living in a home, it's your primary home, it's a different story than if it's an investment property, right? You wouldn't necessarily worry about what your house is worth if you're living in it and enjoying it. And it's a place that you want to live. So that's kind of, again, very high level. In the broader real estate sector, they're still concerned around a lot of the commercial real estate, especially the areas that got overbuilt. So in some markets, it's office space and retail space. In other markets, it's different types of real estate. So there's always that issue. We're still seeing a lot of pressure on office space, especially in areas where a lot more people are work from home or work remote. Bay Area is a big example of that. There's just a phenomenal amount of unoccupied office space, and a lot of commercial real estate is heavily indebted. So you will likely see more failures. You could even potentially see failures of small regional banks that are heavily have a lot of debt issued in that space. You could potentially see failures of some real estate companies that have a lot of that type of real estate because it wasn't a recovery after the pandemic. The hybrid work, remote work thing is probably staying with us for the foreseeable future. And even if it comes back, I think there's a lot more building than we actually have a need for. So you could see some economic issues around that, but they're largely going to be more isolated than a widespread contagion type of thing. So I think I covered there's a couple more of them, but I feel like I've covered them in the other things that I talked about. So hopefully I got everything done. If there's anything else, last minute. I just wanted to wrap up our hour together today to say, as I mentioned earlier, that the economy is very personal and the critical importance of planning around any changes that are happening, not only the ones I talked about today. So there's two levels. One is what you can do as an investor. So in my world, for my clients, I'm going to be very general here. None of this should be construed as investment advice because everybody's situation is different. But diversification is going to be really important next year. S&P 500 is 1/3 tech now, 1/3. You are not diversified if you own an S&P 500 fund, not at all. And if this sector takes a hit, which, for a period of time would be reasonable, you will feel it more than someone with a more diversified portfolio. Okay, not advice, just information. So in my world, much more diversification. There's a lot of opportunities overseas. There's a lot of opportunities in other companies, sectors, but just saying much more diversified in sectors and to be able to ride the growth, but also be more protected from the areas that have grown the most. So this is a prudent portfolio management thing, and that's what I'm doing in my clients' portfolios. In the personal side of things is planning is key. Planning is key. If you haven't already reached out to us, if you're for a financial plan, please do. That's what we do. And to get your specific situation, look at your taxes, look at your finances, look at the whole picture, and really make sure you're optimized beyond the portfolio. Because if we can save you a bit in taxes here or save you a bit over here, that's going to make a plan more successful. So it's much broader than just the portfolio. Final thing is that when we have times of rising markets, right, things are going well, and we've had, with the exception of 2022, pretty good run here, okay, in this bull run. Sometimes that can lead to a little bit of overconfidence and a little bit of, is this portfolio allocation and risk profile still appropriate for me at this time? When things are up are a great time to have that check-in because a lot of times if people will reconsider it's when things are down, right? So do check in with us or your financial professional if you're watching, if you're not clients of Sequoia or FI, please reach out to us or to whomever and just do a check-in. Have them tell you what's the expected volatility, really understand, make sure it's right. Also, since 2008, all of us got older, right? You could be a lot closer to the time where you're going to use this money. So really make sure your 401ks, your IRAs, your investments, everything are lined up from where you are in your life stage and your specific needs. And I bring that up because that's truly, with everything I talked about today, that's my job, the economy. But your job is to make sure that everything is lined up and ask questions to your professionals and just to make sure, because this gives you the higher probability of being successful in your plan, which is the entire purpose of all of this to begin with. So with that being said, I will sign out, and any more questions, anytime, don't hesitate to reach out. And in January, we're going to do the big outlook of 26 with more details and more information. And I already know what it's called, but I'm not telling you yet. You're going to get surprised. and that will go deeper into the weeds. And if more questions come up, like I said, send them. I'll also incorporate it to the next webinar, or email connect@Sequoia.wa. Email me personally, call if you want to talk about any of this in more detail. I'll make myself available. So thank you all very much for listening, and I'll Happy New Year to you, holiday season, and I will see you again in 26. Bye for now.